Have you ever wondered what to do after paying off your mortgage? Well, you're not alone. It's a common question that plagues many homeowners once they've made that final payment and find themselves free from the monthly obligation. It's an achievement, a milestone, and a moment of relief. But what comes next? In the sea of financial possibilities, it's easy to feel overwhelmed or even lost. But fear not, for it's not as complex as it seems. The focus of this video is to help you navigate through these waters, primarily focusing on the tax options available to you after you've paid off your mortgage. Now you might be thinking, tax options? I've just freed myself from a mortgage. Why would I want to talk about taxes? Well, don't worry. We're not here to dampen your celebrations. Instead, we're here to show you how you can use the money you've freed up in a way that could possibly save you even more in taxes. While the idea of taxes may not be as exciting as finally paying off your mortgage, they are an important part of our financial lives. Understanding how they work can help you make informed decisions and potentially save you a great deal of money in the long run. This video will explore different tax options that you can consider. From investing in property to diversifying your portfolio, there are various opportunities that could result in substantial tax benefits. We will delve into the world of property investment, discussing how it can serve as a potential tax-saving strategy. But we also understand that property investment may not be everyone's cup of tea. Therefore, we won't limit our discussion to just that. We'll also explore other tax options that you might find beneficial. Remember, the goal here is not to add to your worries, but to provide you with options and insights that can help you make the most of your financial freedom. After all, paying off a mortgage is a big deal, and it opens up a world of possibilities. Stay tuned as we uncover the tax options you have once your mortgage is paid off. Paying off your mortgage is a significant accomplishment, but what happens next? Mortgage freedom. That glorious day when the final payment is made and your house is truly yours. It's a milestone that signifies not just financial stability, but a whole new world of possibilities. Imagine this: no more monthly mortgage payments. That's a substantial chunk of your income that's suddenly available for other uses. This liberating experience is like being unshackled from a heavy burden you've been carrying for years. It's a breath of fresh financial air, a newfound freedom that opens up a world of opportunities. With mortgage freedom comes a considerable increase in your disposable income. That's the money you have left after taking care of your essential living expenses. The extra cash in your pocket can be quite liberating. It's like a financial windfall every month, allowing you to explore many possibilities that were previously beyond your reach. Think about it. You can now consider investing in a hobby you've always wanted to pursue. Maybe start a small business that you've been dreaming about. Or perhaps it's finally time to take those exotic vacations that always seemed too extravagant. The world really is your oyster. But it's not just about spending. It's about smart spending and smarter saving. It's about creating a financial cushion for your future and securing your retirement. And one of the best ways to do that is to explore the tax options that are now accessible to you. You see, with more disposable income, you can now consider tax-advantaged investment options that were previously out of reach. These could range from contributions to retirement accounts, to investments in tax-free bonds, to buying more property for investment purposes. The point is, mortgage freedom isn't just about owning your home. It's about leveraging your financial success to achieve even greater financial security and prosperity. It's about making your money work harder for you. With more disposable income, you have the opportunity to explore tax options that were previously inaccessible. So stick around as we delve deeper into these exciting options in our next segment. Mortgage freedom is just the beginning of your financial journey. There's a whole new world of opportunities waiting for you. Let's explore it together. Understanding your tax options is crucial to making the most of your newfound financial freedom. So you've paid off your mortgage. Congratulations! That's a significant milestone in anyone's financial journey. But what comes next? Well, one of the things you'll need to navigate is your taxes. While you may no longer have mortgage interest to write off, there are other tax options available to you. Firstly, let's talk about the standard deduction. This is a set amount that all taxpayers can subtract from their income before income tax is applied. If you've been itemizing your deductions to account for your mortgage interest, You might find that taking the standard deduction is more beneficial now that your mortgage is paid off. Now, let's move on to property taxes. Even after your mortgage is paid off, you'll still need to pay property taxes. The good news is, these taxes can still be deducted on your federal income tax return. However, the total deduction for state and local taxes, including property taxes, is limited to $10,000 per year. Next up, we have home equity loans. If you decide to take out a home equity loan or line of credit, the interest you pay on that loan could be tax deductible. However, this is only the case if the loan is used to buy, build, or substantially improve the home that secures the loan. So far, we've been talking about tax options related to your primary residence. But what if you're considering expanding your horizons and investing in property? Well, that opens up a whole new world of tax options. As a property investor, you can enjoy some unique tax benefits. For example, if you choose to rent out your investment property, the rental income you receive can be offset by rental expenses, such as maintenance costs, property management fees, and mortgage interest. This can significantly reduce the amount of tax you need to pay on your rental income. In addition, if you decide to sell your investment property, you could potentially take advantage of capital gains tax rules. If you've owned the property for more than a year, you may be eligible for a lower tax rate on your capital gains. Furthermore, if you reinvest the proceeds of the sale into another investment property, you might be able to defer paying capital gains tax entirely through what's known as a 1031 exchange. Investing in property can be a powerful way to grow your wealth and reduce your tax liability. But as with all investment strategies, it's important to do your homework. Make sure you understand the tax implications of property investment and consult with a tax professional if needed. Investing in property can provide significant tax benefits, but it's crucial to understand how it works. Investing in property is a smart move, but it requires careful planning and understanding. So let's take a moment to delve into the basics of property investment. Property investment is, at its core, the purchase of a property, either to generate rental income or for resale at a higher price in the future, or sometimes a combination of both. It's a tangible asset that, unlike stocks or bonds, you can touch, see, and utilize. Now, let's talk about the different types of property investments. You have residential properties, which include houses, apartments, townhouses, and vacation houses. Then there are commercial properties like office buildings, retail spaces, warehouses, and industrial buildings. Lastly, we have mixed-use properties, which are a combination of residential and commercial spaces in one property. Each type has its own unique set of potential benefits and risks. One of the most attractive aspects of property investment is the potential for tax benefits. These come in various forms, such as deductions for mortgage interest, property taxes, operating expenses, depreciation, and even certain travel expenses related to maintaining your investment property. For example, if you own a rental property, you can deduct the costs of maintaining and managing the property from your taxable income. This can include anything from repairs and maintenance to advertising and property management fees. Depreciation is another key tax benefit. Over time, the IRS allows you to write off a portion of the property's value due to wear and tear, age, and other factors. This can be a significant deduction, especially for properties with structures like buildings or homes. Additionally, if you sell an investment property for a profit, you can potentially defer the capital gains tax through a mechanism known as a 1031 exchange, named after its section in the Internal Revenue Code. Essentially, you're allowed to postpone paying taxes on the profit from the sale if you reinvest those profits in a similar type of property. But here's the thing. While property investment can offer tax benefits, it's not all sunshine and rainbows. There are risks involved, and it's crucial to understand these before diving in. The property market can be volatile, with prices fluctuating due to a myriad of factors, from economic conditions to changes in the neighborhood. There's also the risk of having vacant properties, which can be a drain on your finances as you'll still need to cover the property taxes and maintenance costs. Furthermore, property investment often requires a significant amount of capital upfront for the down payment. And let's not forget the ongoing costs, such as mortgage payments, insurance, property taxes, and maintenance costs. Investing in property also demands time and effort. Unlike stocks or bonds that you can buy and forget, properties require ongoing management. This can range from minor tasks like arranging for regular maintenance to major responsibilities like dealing with problematic tenants or navigating complex legal issues. So, as you can see, property investment is a multifaceted venture. It can be a lucrative avenue for wealth creation and offer attractive tax benefits, but it also carries a level of risk and demands both financial and time investment. As with any investment, it's crucial to do your due diligence, understand your financial situation, and assess your risk tolerance before diving in. In the end, property investment can provide tax benefits, but it's not without risks. So arm yourself with knowledge, seek professional advice where necessary, and make informed decisions to help ensure your property investment journey is a successful one. Property investment can offer several tax benefits, but you need to know how to take advantage of them. This is the beauty of property investment. It's not just about the revenue from rentals or the profit from selling the property. It's also about understanding the tax benefits that can come with it, which can significantly increase your overall return. Let's start with depreciation. Now, depreciation might sound like a negative term. After all, who wants their property to depreciate? But in the world of tax and property investment, depreciation is your friend. It's a tax benefit that allows you to account for the wear and tear on your property over time. Essentially, it's a deduction you can take each year on your tax return, which can help reduce your taxable income. The less income you have to pay tax on, the better, right? But how does depreciation work? Well, when you purchase an investment property, you can claim a tax deduction for the decline in value of the building structure and the items within it, like appliances and fixtures. This is called capital works deductions and plant and equipment deductions, respectively. Remember, these deductions are only available for income-producing properties. So if you're renting out your investment property, you're in luck. Next up is tax deductions. When we talk about tax deductions in property investment, we're talking about the expenses you incur while owning and managing your investment property. These can include interest on your investment loan, property management fees, repair and maintenance costs, insurance, and even travel expenses to inspect the property. By keeping track of these expenses and claiming them on your tax return, you can further reduce your taxable income. Now, onto capital gains tax. When you sell your investment property, you may make a profit, which is considered a capital gain. This gain is generally subject to capital gains tax. However, if you've owned the property for more than 12 months, you may be eligible for a 50% discount on the capital gains tax. This means you'll only pay tax on half of the profit you make from selling the property. But wait, there's more. Did you know that if you live in the property before renting it out, you might be eligible for a 6-year exemption on capital gains tax? Yes, you heard it right. If you move out of your home and rent it out, and then sell it within 6 years, you may not have to pay any capital gains tax at all. Moreover, if you're a real estate investor who flips properties, you might be able to classify your profits as business income rather than capital gains. This can potentially lead to significant tax savings. To sum up, property investment can provide you with several tax benefits, from depreciation and tax deductions to capital gains tax advantages. However, it's crucial to keep in mind that tax laws can be complex, and they can change from year to year. Therefore, it's always a good idea to seek advice from a tax professional or a financial advisor who specializes in property investment. Remember, every investor's situation is unique, and what works for one person may not work for another. So, it's important to understand your financial goals, risk tolerance, and investment strategy before deciding on the best approach to maximize your tax benefits. Understanding these tax benefits can help you maximize your investment and minimize your tax liability. So why not start exploring the wonderful world of property investment today? While property investment offers tax benefits, it also comes with its own set of risks and challenges. Let's start with the elephant in the room, market volatility. Just like the stock market, the property market isn't immune to fluctuations. Property values can rise or fall based on a multitude of factors, including economic conditions, interest rates, and even the general mood of buyers and sellers. While a well-selected property in a strong market can yield significant returns, an economic downturn or a slump in the local property market can leave you with a property that's worth less than what you paid for it. Next, let's talk about property management. Owning a rental property isn't just about collecting rent checks. It involves finding and screening tenants, handling repairs and maintenance, dealing with any legal issues, and ensuring compliance with property laws and regulations. If you're not prepared to take on these responsibilities yourself, you'll need to hire a property manager, which can eat into your profits. Then there's the issue of unexpected costs. When budgeting for a property investment, it's easy to focus on the purchase price and forget about the ongoing costs. These can include property taxes, insurance, maintenance, and repair costs, and even unexpected expenses like a major plumbing issue or a roof replacement. These costs can add up quickly, and if they're not factored into your budget, they can turn a seemingly profitable investment into a financial drain. Now let's talk about liquidity. Real estate is considered a relatively illiquid asset. This means it can take a significant amount of time to sell a property, especially in a slow market. If you're in a situation where you need to convert your property into cash quickly, you may be forced to sell at a lower price, potentially resulting in a loss. Another risk to consider is vacancy. If you're unable to find tenants for your property, you'll still need to cover all the costs associated with the property, without any rental income to offset these expenses. Depending on how long the property remains vacant, this could have a significant impact on your return on investment. Lastly, let's touch on interest rate risk. If you're using a mortgage to finance your property investment, changes in interest rates can affect your costs. If interest rates rise, so will your mortgage payments, which could turn a profitable investment into a loss-making one if rental income doesn't keep pace. While these risks and challenges might seem daunting, they're not insurmountable. By doing your homework, planning carefully, and staying informed about the property market, you can mitigate these risks and increase your chances of a successful property investment. Remember, investing in property isn't a get-rich-quick scheme. It requires patience, diligence, and a long-term perspective. So, before you dive into property investment, take the time to understand these potential risks and challenges. Consider how they might affect your investment strategy and your financial goals. Seek advice from professionals, such as real estate agents, financial advisors, and tax experts. And always have a contingency plan in place, because in the world of property investment, it's always better to be prepared for the unexpected. Being aware of these risks and challenges can help you make an informed decision about property investment. Apart from property investment, there are other tax options you can explore after paying off your mortgage. One of the most popular ways to save on taxes is through retirement accounts. These accounts provide tax advantages for retirement savings, and there are different types for different situations. For instance, a traditional IRA allows you to make contributions with money you may be able to deduct on your tax return. Any earnings potentially grow tax-deferred until you withdraw them in retirement. Similarly, Roth IRAs allow you to pay taxes on money going into your account, and then all future withdrawals are tax-free in retirement. Now let's switch gears and talk about investing in the stock market. Stocks represent ownership in a company and can provide significant tax benefits. When you hold on to a stock for more than 1 year before selling, any profit you make is considered a long-term capital gain, which is typically taxed at a lower rate than your regular income. This is a fantastic way to grow your wealth and take advantage of tax benefits at the same time. Bonds are another solid investment option. When you buy a bond, you're essentially lending money to a company or government entity. In return, you receive interest payments over a set period and get your initial investment back when the bond matures. While the interest you earn from bonds is generally subject to federal income tax, certain types of bonds, like municipal bonds, can be exempt from federal and sometimes state or local taxes. Investing in a 529 plan is another excellent way to get tax benefits. These plans are savings accounts specifically for future education costs. The earnings in a 529 plan grow tax-free, and withdrawals are also tax-free when they're used for qualified education expenses. Health savings accounts, or HSAs, can also provide tax advantages. Contributions to an HSA are tax-deductible, the money grows tax-free, and withdrawals for qualified medical expenses are tax-free as well. However, it's important to note that you must be enrolled in a high-deductible health plan to qualify for an HSA. Lastly, let's not forget about charitable contributions. When you donate to a qualifying organization, you can deduct the contribution on your tax return. This is a wonderful way to give back to your community and save on taxes at the same time. Exploring these different tax options can provide you with a diversified portfolio, which is a key strategy for minimizing risk. Remember, a diversified portfolio can help to smooth out returns over time and reduce the likelihood of a significant financial loss from a single investment. So there you have it, a brief overview of other tax options apart from property investment. Before you dive into any of these options, it's always a good idea to consult with a financial advisor or tax professional. They can help you understand the potential benefits and drawbacks based on your specific situation and financial goals. Exploring a diverse range of tax options can help you diversify your portfolio and minimize risk. Paying off your mortgage is a significant milestone, but it's just the beginning of your financial journey. The journey towards financial freedom is, indeed, a marathon, not a sprint. We've traversed quite a landscape today, discussing the various tax options available to you once you've reached that pivotal moment of mortgage freedom. Let's take a moment to revisit the key points we've covered in this enlightening journey. The sensation of making that final mortgage payment can be exhilarating. The feeling of owning your home outright, free from the monthly obligation of a mortgage payment, is indeed a moment to savor. However, the end of your mortgage doesn't mean the end of your financial responsibilities or opportunities. Quite the contrary, it's the commencement of a new chapter where you can explore a range of tax options. We delved into understanding these tax options, highlighting the significance of being well-informed and proactive. It's crucial to comprehend that your tax situation will change once your mortgage is paid off. The mortgage interest deduction that you've been accustomed to will no longer be available. However, this shouldn't be a cause for concern. Instead, it should be viewed as an opportunity to explore new avenues for financial growth and tax savings. Next, we ventured into the realm of property investment, an enticing avenue that offers additional tax benefits. Buying an investment property can provide a consistent source of income, appreciate in value over time, and offer substantial tax advantages. These tax benefits can range from depreciation deductions to deductions for expenses related to managing and maintaining your investment property. However, as with any investment, property investment isn't without its risks and challenges. It's essential to conduct thorough research, understand the market, and consider your financial situation and risk tolerance before diving in. And remember, while property investment can be lucrative, it's not the only avenue for tax savings. We also explored other tax options that can help you make the most of your mortgage-free status. These include maximizing your retirement contributions, investing in tax-efficient funds, and considering charitable contributions for tax deductions. The key is to understand your financial goals, consult with a tax professional, and make informed decisions that align with your financial objectives. As we reach the end of our journey, let's remember that financial freedom isn't just about being debt-free. It's about making informed decisions, understanding your tax options, and planning for the future. It's about maximizing your income, minimizing your taxes, and securing your financial future. Keep in mind that every individual situation is unique, and what works for one person might not work for another. So it's crucial to consult with a professional who can provide personalized advice based on your specific circumstances. Don't be afraid to ask questions, seek advice, and continually educate yourself. Remember, knowledge is power, and the more you know, the better decisions you can make. In conclusion, paying off your mortgage is a significant accomplishment, but it's just one step along the path to financial freedom. The journey doesn't end there. With the right knowledge, planning, and decision-making, you can navigate the landscape of tax options and investment opportunities that lie ahead. With the right knowledge and planning, you can make the most of your financial freedom and secure your future. So here's to your continued journey towards financial freedom and prosperity. May it be filled with sound decisions, wise investments, and fruitful returns.